Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-session update for Thursday, July 8th, 2021. There are some things worth pointing out in this video. We'll keep it relatively brief. I'm going to start out with the broad markets, quick look at the VIX and Treasury bonds, as well as some of the market-leading FAANG stocks. Those all kind of interrelate closely. I'll do a quick update on commodities, just the broad commodity ETF DJP that I've been highlighting recently. There's obviously a development to note there. And then quick updates on lumber, crude oil, and one of my favorite sectors right now on the short side, which is retail sector. All right, so we're going to start out here. We're looking at QQQ. I did post an update this morning with 60-minute charts, and this is the same trend line here. So this is, to me, one of the, if not the most significant level on the major indexes right now is this near-term uptrend line that comes off the mid-May lows right here. And you have quite a few reactions along the way to help validate that level. Big divergences on the daily chart building in extreme overbought conditions. I mean, you can look at this level here. I'm going to roll back. I'm referring down to the bottom of the screen here, and you can see that we're near that. I have a purple line of about 80 on the RSI, and we are just a hair under it, or reverse just a hair below it with divergence. And so really what I look for, divergence in a bull market, it's usually not, let me back up. Overbought conditions usually in a bull market continue, they become more overbought, and it's usually that second lower overbought reading that does the trick. So in other words, it gives you that divergence. So right there we hit it, and we did. It was certainly, you don't want to be going long when you're at 80 on the RSI. That means market, or in this case QQQ, is extremely overbought, and there was a big, in fact the biggest correction over the past year came on that reading. There we are, very close to it again, and you can see here again, you were very overbought. There was a little blip, but not much. But then it was that second lesser overbought reading that gives you the divergence, that downward sloping line with prices going up. That is negative divergence, of course. Divergent high, a much bigger divergent high right here. It's been building since that time. So just wanted to point that out. And then, of course, go back here. Let's just do this and we'll move on. There we are, we hit it right there, and in itself that was enough to put a nice correction, maybe 10% or so. I haven't measured it out. High single digits, low double digits, and then again we eked on, put a marginal new high, and then another correction there. And this one was more in time, really. We went sideways for a couple months there to work off the overbought conditions. We had divergence there, same thing. We had it right here, and that was a much bigger correction. So bottom line is the odds, even if we push up higher, tag that level again, the upside is typically limited, and the odds for correction are raised substantially when you have overbought. And then again, the bigger corrections usually come after that second overbought reading with divergence in place. And then take it down to the 60-minute chart if you want to hone in on your entries and exits. Same chart I posted this morning. There's our primary uptrend line. That's why it's a little thicker colored, a little brighter there, a little thicker line. And we hit it to the button today. It's the same line I've been highlighting recently. And there was that minor trend line. Now, on the futures, they broke down at like 1 a.m., 2 a.m. last night during the night. So that's why QQQ, you see you got a gap down here. So a futures trader could have exited or entered a short position on the break of that trend line. Let me get to that, and I'll show you that again. We covered it. That was a chart went out this morning on NQ, the NASDAQ 100 futures, which I have right here. Nice clean chart, and there it is. So this is the level we've been watching for the last few days. This minor trend line, and that's where we broke it. We broke it last night, and then boom, very impulsive drop to the primary trend line. So you could have, again, active trader would have, could have stepped in and covered a short trade there, even reversed it long for the bounce. There's been a tradable bounce so far. And then now that we've broken the minor trend line, now we await a break of this primary trend line on the 60-minute chart for a more powerful sell signal on NQ or QQQ. So bottom line is this morning it was not objective to go short. We hit that level right at the open. We gapped down, hit the trend line on both QQQ, and right after open we hit the primary trend line on NQ. So if anything, you cover a short and or go long, or sit tight, do nothing, and wait for a break of that level, and that will give us our next sell signal. And then I already laid out the targets And again, same chart that I posted this morning. These are all potential targets. And depending on what happens, if and when we get the sell signal and this starts to play out, then I'll turn my focus to the daily charts to see which of these is likely to cap the downside, if any. There's potential we could go down and hit that target and keep going, but as of now, near-term targets on NQ. Okay, so all that was covered earlier. There's not too much in ES. I think I covered this trend line recently. Yeah, I would have. I had a little trend line here that broke. It was an impulsive drop, and then we set up this trend line here. We had a couple tags, so that if I covered it in yesterday's video, which I believe I did, that would have been your pattern. Yeah, there it was with the negative divergence and everything. And so there you had dual sell signals, both the ES S&P 500 E-mini futures, which we're looking at here, 60-minute chart, and NQ. They both broke down last night, and that was that initial thrust. And what I'm going to do is give you some levels. Now that we have this reaction low right here from today, from this morning, I'm going to put a line right around there at the bottom there, because that's the level to watch. And there's also some minor support you can see in here, some reactions along the way right here. So that helps to validate it, especially that's a nice reaction there. So here's our number right now, 42.7960. Well, round that down, it'll be 42.7950. Give or take, you can call it 42.79. Will open the door most likely to the next drop down to any or all of these targets on ES right there. And we're below trend. The divergences are intact. There's an example of an extreme overbought reading here, but on the 60-minute chart, remember I showed you that earlier on the daily chart of QQQ, we're looking at a 60-minute chart of ES, and rarely do you get up that far. When you get up to or near that line, that's usually you're going to get a correction. That's typically the way it works. You peaked out there, yeah, you may had a little divergence there, you made a lower low on the RSI, and then boom, there was your drop. Here you had that, kept diverging actually to this point, and then boom, the big drop there, and there's divergence. So that's why I think we'll probably take another jog down, and I'll tell you right now, it's been a pretty healthy snapback rally. You can take a shot here, add to a short. That's probably going to cap. I think we've probably seen most of today's bounce, but if you want to play it safe, the uptrend has been resilient. Wait for a break of today's lows on both ES and NQ, or QQQ and SPY, either one, whatever your trading vehicle is. And then RTY, let's not forget the small caps. A lot of folks like to trade those. You usually get more bang for your buck when trading the small caps. Laid this out in the last couple weeks. I had a little trend line here, negative divergence that had been building. So typically the bigger it builds, you have a little divergence, a little drop, bigger divergence, so far bigger drop. And I laid out these targets back here when we got that sell signal. First target, it was hit, 22.98. We consolidated around it for a while. Once we broke it, that's the way it works. Typically get a reaction on the initial tag, it is support, and then once support breaks, it broke. We didn't just limp down, we went straight down, hit my second target at 22.6150, had a reaction there with a little momentum overshoot, and then boom, we took it out, and what did we do? It wasn't very long till we hit my next target, 22.07. Probably more downside to come, that is support. And then we put in that reaction low. It was a quick drop, and again, I call that a momentum fueled overshoot. When you have a lot of velocity or downside momentum, you'll tend to overshoot a target. It's or support level, only to snap back afterwards. So where we're at right now, these snapback rallies, you want to look for, you might get up to those targets there. This one's become a little sloppy because we had the overshoot. And again, my preference would be to, if you are interested, to short back into this rip. If you happen to cover that target this morning, I think you can short right about here with a stop somewhat above here. I'll tell you what, if you want to keep it tight, maybe right above this reaction high right there. We really have no business going there. And if we do, then this is still resistance here, 22.9870 or so. So depending on how much you're looking for, that will determine what stops to use, whether you use tight or a more liberal, wider stop. All right, let's look at Mr. VIX here, the VIX Volatility Index. And this one, I've talked about before. It kind of looks like an EKG if you turn off all the lines, especially all the trend lines there, that is. And you get these blips every so often, and sometimes you get bigger blips, and that's it. And they tend to work in fairly regular intervals. You can't use it as a pure timing indicator. You can't say, oh, I'm going to go long the VIX every 1.6 months or whatever, but you can see every so often you get these spikes in volatility. And then more so, the VIX trades very well to the technicals. What I mean by that is divergences, the same divergences. Right here, you had positive divergence there. You had positive divergence right here. You had positive divergence here. These rips are often preceded by positive divergence, and it's just like looking at the stock market upside down. So the same, just like we have negative divergence on the indexes now, we have positive divergence on the VIX. And it's up today pretty good, about 13-14% now. Went up, I believe I had these targets listed before, these resistance and support levels, 22.42, and that's what we hit today. So we popped, and it's moving up, starting to move up impulsively. And 60-minute chart, again, daily chart has this positive divergence, and the 60-minute chart also had some positive divergence. We roll back here, simple stuff. Look at the 60-minute chart. You had positive divergence right there, right? Nice and clean. And we rallied from that point. I got to grab a little lower so I don't move the trend line, and then I'll stop a little bit above there. That was about an 81% rally. Here was positive divergence again, and that was a quick pop of about 63% positive divergence right here. Nice little wedge too you had to break out of. I got to grab a little lower so I don't move my support line there. Then I'll stop a little above, or a little below, that's about 73%, that pop right there. And here we are now, and the reason I measured those out is to let you know we've only gone up 40% or so, 39-40% off the bottom. It's a big move, but it's not big for the VIX. Again, that's why I measured these out and told you what the moves were. And so far, it would indicate there's more to come. And we stopped right at good resistance too, that 2018-ish level. You can see that's resistance. So there it is. We popped today's highs. That's probably going to coincide or come right around before or shortly after a break of today's lows in the indexes. So you want to put the odds in your favor. Maybe you're gun shy shorting this market. It's true, it's been resilient. Pullbacks have been bought up for a while. Volatility's been low, but we are seeing volatility expand. Today is one of the bigger down days, or it still is in the indexes. So volatility is picking up, and that's usually when you want to be short. Volatility picks up typically when the market corrects. And so there it is, guys. Break above there, 2018 should take you up. There's some reactions along the way, but that's my next resistance on the VIX 60-minute. Now, you can't trade the VIX directly. You can buy options on the VIX, or actually you're buying options on VIX futures. You can buy VIX futures or options on those futures. This one keeps splitting because if you hold VXX, and there's a couple others out there, it's an ETN that trades those futures, tracks the VIX futures, and every now and then it does reverse splits because over time you will lose everything on this. You cannot hold these. These are in and out quick trading vehicles. But what you have here, I'm going to move these lines. We have nice divergence setting up. Forget about that support level. It's from a long time ago. Again, every time they reverse split this, my lines get shifted. This charting program unfortunately doesn't adjust for the split, so I've got to move these trend lines. The divergence lines remained intact. You can use this, but you're going to have so much decay in here. I don't put too high a weighting on these. That's why I spent time starting with the VIX, covering the VIX, to show you the levels to watch. So what I do if I'm trading the VIX is I'm going to correlate my entries and exits, correlate this chart with the actual VIX itself. And but with that being said, sometimes sellers will use these and they'll step in. So there's a potential trend line. And the takeaway here is the decay here is quite a bit. So I don't think we're going to get back to this level again, because over time this thing's just going to decay and go lower and lower and lower. But the VIX itself kind of goes range bound, or not range bound, but somewhat range bound. And here, this is a daily chart of the VIX going back for the last few years. So you can see, from periods of low volatility and pullbacks to support, and those support levels change over time. This was support for quite a while right here. Then this became support level. Well, we had a little support level down there. Sometimes this is support up here, and we pulled back to this area there. maybe we go down here. If we get down here, the market's got more upside to go. However, again, lots of divergence setting up. This is support here, and we're above it now, 1622, and these are all potential targets for the VIX. And a big spike would probably take us above that level. I don't foresee that now anytime soon. Things are really relatively stable right now, but market conditions can and often do change on a dime, and it's from those periods of very low volatility that come those big spikes. So the point is, be flexible. Watch the charts. If you go long any of the VIX ETFs, then just watch the indexes, and if it looks like we're going to bounce or a correction's over, you want to get out of the VIX, because the VIX, as fast as it can go up, it can fall just as fast, and you can watch nice profits disappear in the blink of an eye. Okay, enough on that. Just wanted to kind of show where we're at and how it's perking up today, and has been lately. TLT, these are government U.S. Treasury bonds. They continue to go up. This is quite often a red flag for the stock market. When the stock market is rising, not necessarily today, but for the last several weeks or a couple months, yet you can see Treasury bonds rising. And that is usually, when you see bonds rising along with the stock market, that's institutional investors moving money into treasuries in advance of a correction. So we'll see. Anyways, it's typically, if not a red flag, we'll call it a yellow flag, caution flag for the stock market to see treasuries rising like this. And again, I covered those the other day. Let's look at a couple of the FAANG stocks and we'll move on. Market leading FAANG stocks, FAAMG. Apple. Here's what Apple looks like. Apple has gone nowhere, world's largest company now for, what is that, over a year. This is last July right here. We entered this trading range, and here's our all-time high in Apple, and we just recently came and pretty much tested that again. So look, Amazon just broke out. I'll get to that in a second. That was on that contract news where the government pulled the contract from Microsoft. Which opens the door to allow Amazon and even Alphabet come in and get a piece of that huge government contract. It was in the headlines 2 days ago. But here, right now, at this point in time, we have a double top. Now, we can't write Apple off just because it reversed off that test of that previous all-time high right there. Doesn't mean it can't power up and break through. So what I'm watching on Apple, just like the Qs, we have an uptrend line, a near-term uptrend line. Break that, it's going to be bearish. And then bigger picture would be, if you get a double top pattern and we start moving down to the bottom of this trading range, or really even below here, that's going to be quite bearish. What makes me think that if we break out, it's not going to be a runaway? Because, I can see this. I completely get this. And I can see if you're, a long-term bull on Apple or the market. I always talk about trading ranges acting like a coiled spring, building energy, and the direction you break typically determines the next major trend. And an upside break is certainly possible. However, you can call me, the pessimist if you want, but when I look at this, there's Apple. This is an overbought reading of about a little over 80, almost 81. You have overbought right here. And we're just going to go to, let's turn off these lines and look what happened to Apple every time it was this overbought. And so my point is breakouts that occur with extreme, and this isn't just overbought. This is 70. This is considered overbought right here when you're 70. That 80, 81-ish level is extreme overbought. All right, so I'll clear the lines and just do this real quickly. So we are overbought. Last time we were that overbought was right here. You can see what happened to Apple then. That was the biggest drop in at least a year or so, or close to it, before the COVID lows. Just before the COVID lows right there, we became overbought. We stayed overbought for a little while, and then boom, the big drop into March of 2020. So you get the picture. You basically either want to be closing your longs, shorting Apple, getting ready to short it, of course, maybe with a sell signal, or at the very least, you don't want to be buying Apple, and that's why I suspect that any breakout would most likely fail because of the extreme overbought conditions. Doesn't have to fail the next day. It just tells me the upside is probably very limited before we reverse and fall back into the range, and that's assuming it even breaks out. Right now it hasn't. So that's Apple. Microsoft looks a little better. because it's at a new high and it's held that high, but you have these same uptrend lines. So this is what I would do. If you're serious about trading the markets, replicate these uptrend lines. It's almost identical as the one on QQQ and NQ that I started with. We have them all, these big fangs. And my guess is if we take it out on NQ and QQQ, you're going to take it out on these guys. These are the market leaders. And it's these big divergences and overbought conditions like you have down here that say we'll probably break it and correct soon. Microsoft well above its multi-month trading range. It broke out. 228 was the big number right here, and I talked about this before. There was a breakout, successful back test for a few weeks actually, and moving higher. So come on down. That would be a very nice buy point if the charts confirm if we get there, but it's going to be an ugly ride down if you're long, because that'd be about an 18% drop in Microsoft, which would obviously put a lot of pressure on the indexes due to its weighting. And there's Amazon. As I mentioned, Amazon broke out recently. It was a news-induced pop, but take it for what it's worth. There's a multi-month trading range, or I should say a year-long trading range to be more exact, and it popped right there. There was your breakout candle, and so far it's above it. So what I'm watching for Amazon, that is bullish until and unless it fails. The fact that we are at that extreme level, my number on Amazon on the RSI is about 78.50. And again, this is what, to me, technical analysis is all about: identifying patterns in the chart that mirror or are similar to past patterns, whether it's a bullish or bearish chart pattern, candlestick formation, things like this, overbought conditions. And you decide, did you want to go long right here at this tag of that 78.50 level on Amazon? If you did and you bought that, you then ended up losing about 26%. It would have stopped almost anybody out. Right here, you became overbought. So let's just say you bought it. Right away, you dropped down 14%. Again, probably would have shaken anybody out that bought that high. And let's say you had iron hands and you went up, you held it here. You went up, you made about 4% from where you bought that high, but then you dropped down 19%. And you've also gone nowhere in about a year because this one's gone sideways. So that's those are the conditions that I'm looking at in the market, and they're not very conducive to more upside. Maybe we flounder around in a range for a while. Maybe we correct. These ranges are very long in the tooth. It would be quite unusual to see much more of sideways trading among these big FAANG stocks, for it's already been a year, like I said. All right, so that's that. Let's move on and talk commodities real quick. DJP is an all-inclusive commodity ETF that I've been highlighting for a while now. It has everything in there: gold, crude oil, natural gas, corn, soybeans, copper, aluminum, silver, live cattle, and more. And the reason I wanted to update it, we are once again at the trend line. So I've been updating this since somewhere around here, highlighting this beautiful price channel. Commodities are in a bull market. Obviously, you can see that. There's an upward sloping price channel. But right here, I said, look, time to cool down. Maybe stop adding to commodities or get ready to short if you're an active trader. We're at the top of the channel. It's a wash, rinse, repeat thing. You get to the top of the channel, then you break the little minor trend line, which we did, and then the next stop is usually the bottom of the channel, which it was. And we're back to the bottom of the channel again. So, couple takeaways. That is, as it was here, an objective long entry if you want to go long DJP or select commodities. There's a little caution to be had because, as I've mentioned, what makes this pullback different, really this high different, I should say, is we've had this divergence forming since, negative divergence, with the prices making these higher highs within that channel, but pretty steep divergence. So that is the glass half empty view, or at least why we need to have a little caution here and be aware that if we do break below the trend line, we could head down. Again, I have a potential downside target about 23.33. There's some other stops that we'll probably have along the way if we get there. Now, divergence in a bull market, and we've seen that with the stock market in recent years, quite often gets burned through. So it is possible that these divergences will eventually get taken out. We're still above the zero line here with the PPO signal line, and that is a bullish trend indicator. When that white line here, you usually pull back to the zero line, and that acts as support. So, you can make either case. Right now, nobody could argue that the commodities are not in a primary bull trend. And it'd be hard for anybody, at least from the way I see things, to argue that commodities are not at support, which they are. That's particularly this ETF. So that's that. You can step in and buy and put a stop below. You can sit back, wait to see how this is resolved, or if you're bearish, you can short. Maybe the commodities break down and go down there. Like I said, I'm, in the bull market, I'm less inclined to short, more inclined to buy pullbacks to support. So let's leave it at that and move on to the next one. That brings me to lumber. Want to do a quick update there. I still like lumber. Lumber has pulled back today. It's down 5%, but remember, this is a 30-minute chart here that I've been posting. We had the primary 60-minute, I'm sorry, this is a 30-minute chart, but you can replicate it with a 60-minute chart. We had the downtrend line, we had bullish or positive divergence, we hit support on the daily, and we went up and hit my first target right here to the button. This line is just a measurement tool that I have up to my third target if that's hit. So far, this is still more of the reaction. We hit first T1, target was hit, and we pulled back. I'm still favoring a move up to at least T2 and quite likely T3, but we got to take out T1. It was the first resistance, and so far the typical reaction is a little, said you could have bought it yesterday, you could still buy it today. There are no guarantees. We could take another leg down. There is obviously some additional support that's not too far below on the daily chart. You don't see it here. And also keep in mind, if we do have another leg down, these divergences are still very much intact. So you could have another jog down, take out that recent low, probably clear a lot of stops, and put in an even larger divergent low in lumber futures. If you're trading this one, I don't need to tell you. Again, if you're, got a big portfolio size, that contract's not too big for you, but it's about an $85,000 contract, each futures contract in lumber. So, if you're going to ride out that much, you just have to put it in percentage terms. What's it going to do to me? Knowing that this thing tends to go up and down. On a good day it's up 5%, on a down day it's down 5% like today, and you just have to count that into your position size, or if that's too much for your portfolio to be properly diversified, just trade something else. All right, so that's that. So far, again, still looking for more upside there, but I told you one thing that could throw a monkey wrench in these targets here would be the stock market. Stock market's been humming along, and that's why I've been bullish on lumber lately after the 60% correction. But if the stock market really starts to sell off hard, it's typically correlated with the a deterioration in future growth expectations for the economy, and that'll put the brakes on the housing market and everything else. So is it possible lumber can rise if the stock market? Yeah, it certainly is. It's very oversold. Maybe you see rotation in this commodity. So the main thing is use stops that are in line with your price targets as well as your risk tolerance, and I'll continue to update that as long as it looks good. But again, I'm more inclined to be a buyer at these levels, even if there's another leg down to the next support levels, than I would be care to short this at this point. All right, next up would be oil. Oil, one of my top picks for a longer term swing short at this point in time. Let me find my CL crude futures chart, and you can use USO or some of the ETNs at short oil. All right, so this is the 60-minute chart of crude futures, CL right there. Hourly candlesticks, divergent high, correction, divergent high, correction, divergent high, correction. But this current divergent high is really an extension. We've been diverging for a while now here on the 60-minute chart. Then we broke this minor trend line the other day. We went down, we hit my first target right there, so that should say hit now. And we reversed just shy of T2. We bounced back and we're back to T1, which, remember, that was support right here, about 72.50, and it's now resistance. We're at 72.52 as I do the video, well, 72.43 once I cleared the drawing tools. So that's it. We're right at back to that T1 level. Very objective shorting off, in my opinion. You can keep relatively tight stops, or you could, a little bit more liberal stops if you want. and I still favor a move down for a full tag of T2. We reversed a little shy of it. I think you can see that in the video, and if not, I'm going to zoom in a little bit. There it is. Let's put it on candlesticks. Those are bars. Yeah, a little shy of T2, so I think we'll go down and at minimum hit that, and then most likely continue on down to T3, and then maybe a lot more. I've spent quite a bit of time reviewing the longer term charts of crude oil. I have us rallying to major resistance on the daily chart with big divergences, and I think there's a lot more downside potential. At this time, let's just say that's my final near-term target, but if and when we start to get near T3, I'll give you my thoughts to let you know if I think there's more downside to go. Alrighty, that leaves us, let's just wrap it up here with another update on XRT, one of my favorite sectors on the short side right now. The retail stocks, just covered it yesterday, so I'm not going to go into a lot of detail. It was down today quite a bit, flirting with this trend line, little stick save, or we're right about on there. Maybe just a hair under it right now. But again, the case was made, big divergences forming. Some of these retailers have just gotten this insanely overbought. Yeah, there was the whole coming back online with the economy thing, especially for the brick and mortar stores. Obviously, Amazon was a big beneficiary of COVID, more people shopping at home. But then you have one of my favorites is, to scale into or take a hard position is that EMTY I pointed out yesterday. That's ProShares decline of the retail store ETF. So it has your brick and mortar retail stores in there, and a lot of upside potential. I gave you targets there, and for this time being, let's just keep an eye on this 2264 potential target. Work to be done, but that work will be everything I began the video with. ES, SPY, the S&P 500, QQQ, NQ. You want to see those today's lows get taken out, and when that happens, I would put good money on the fact that retail stocks will outperform to the downside, meaning drop more, and you can short XRT. There's a couple others out there. XRT is one of the big ones. That's the one I usually follow, retail ETF, or just buy EMTY, and it's only one-time leverage. It's a negative one-time inverse. That means it tracks the retail sector inversely without leverage. Again, I think you'd outperform on the next correction, or short it now, or buy EMT now, and I think even if the market goes up, you'll still outperform. In other words, what happens is you can short a sector like this, and maybe it continues to go up a little bit, but it should go up, in my opinion, less than the overall market. So basically, the S&P 500 is this is likely to underperform the S&P 500, whether the S&P continues up or drops. All right, we're going to wrap it up here, and I'll continue to hunt for trade ideas, but right now let's focus on these. Oh gosh, guys, I almost wrapped up, and I wanted to do an update on gold. I still like gold. Gold GC, this is the 60-minute chart. We broke out of this bullish falling wedge. We had this near-term trend line. We already hit my first target right here. We broke the trend line. We back tested, but this is good support, this R1 level, and gold's still holding that support. Why do I like it? It's not only the chart of gold that I like. There's silver, by the way, also recently, silver futures SI recently put in the divergent low as well right there, and pretty decent support around 25,764. Decent, not the best, but decent support, especially recently. So you can buy it here right now around support with a stop somewhat below. Swing targets would be 27,511, 28,490, or you can use SLV, the ETF. And then I wanted to show you the dollar index. Okay, here's why I'm still liking the gold trade right now. Let me make sure this chart's up to date. Nice clean up trend line on dollar futures. I pointed this out recently. Bearish rising wedge pattern. It broke down right here. We back tested once, twice, and rolling over. I have a pretty high degree of confidence this is going to play out. If it does, gold is dollar sensitive. They usually move inversely to each other, and so I'm calling for downside in the dollar at this point, which should correlate with, and we just extended that divergent high on this back test right here, guys. Pointed the breakdown out the other day, but this back test right here only extended the negative divergences that were already in place. So there's the case for a drop in the dollar. And of course, you can also look at the euro. The euro is usually going to move inversely to the dollar because that's the biggest component of the dollar index. And just like we have the negative divergence on the dollar, we have positive divergence on the euro. Let's put it like that. So there's our bullish falling wedge pattern. If you want to trade the euro as a pure play, that E7 or euro futures, or FXE is the ETF or ETN technically that tracks the euro. And so again, this to me looks like the euro is ready to rally, the dollar's ready to fall, and that gold and silver and GDX should be the beneficiary of that. And now we will wrap it up. This has been Randy Finney with Right Side of the Chart. Have a great day.